Welcome to Retirement News Today. With equity markets at all-time highs, many investors are still unsure if the current levels can be maintained. As a result, an increasing amount of investment dollars are flowing outside of the markets and into alternative asset classes. One in particular, life insurance, is gaining popularity as a place to grow wealth. Here to discuss the use of life insurance as an alternative asset is Denver Noes of Wealth for Life in Scottsdale, Arizona. Denver, it's good to see you. Welcome back.
Nice to be here today, Scott.
So while life insurance policies do have established tax-favorable status, is life insurance a good or bad investment?
Well, it depends on how you set it up. If you set it up wrong and you buy the wrong type of policy, it can be very expensive and not a good place to grow wealth. If you set it up properly, it can certainly provide you a lifetime of tax-free income to a level which will really outperform any of the other alternative assets out there. As an example, we had a client recently who we structured a plan for. They were funding about $250,000 into their plan. Over the course of their life, based on the historical yields, we're able to pull out about $2 million in tax-free income for them. So that's a pretty unbeatable income stream from a safe asset.
Denver, that sounds like a very good return on an investment. What type of policy does one want, and how does the insurance company grow the money inside the plan itself?
Well, choosing the right type of policy is critical. We use Indexed Universal Life, or IUL for short. Within those policies, the insurance companies will use a variety of market indexes like the S&P 500, the NASDAQ, the Dow Jones. You'll have an annual cap on gains on a lot of the strategies. On some strategies, they will actually have no cap. So if we look at the last 12 months, the types of yields that those policies were crediting was in that 10% range on to the high end, about 20%, depending on the index and the strategy that we were using. Now, the important thing that will happen then is any of those gains that were credited into that policy over that 12-month period lock in. They become permanent. They can't be lost in future years due to market downturns. And then also, if the markets are down, you have a 0% floor that protects you, so you're not losing those previous year's gains. If the markets do go down for the year, you get that zero like I mentioned, but then one of the most important things happens automatically in these policies is that you now reset to the lower point. So your funds are now positioned at a point that is 20, 30% lower as the markets have crashed. You're automatically positioned to capture the rebounds. Markets start going back up. You have a gain where most investors are just battling to get back to even. So it's that combination of the ability to lock in gains when you get them, the floor to protect you from losses, and then resetting to capture the market rebounds. That's what gives you these kind of very high, steady long-term yields in that 7 to 9% range. And doing it on a tax-free basis is a pretty big advantage.
Well, Denver, it sounds like you have the best of both worlds. You have growth potential and tax-free income. What's the downside?
Well, I think the downsides are the costs that you have to pay going into the policies. So all the policies are going to have a state and federal premium tax that will usually range in that 5 to 8% range. Plus, you're going to have the cost of insurance and the expense charges. And all those costs are going to generally be higher in the first 10 years of the policy. Then from that point on, about year 11 plus, they'll usually drop by about 80%. Over the life of that policy. And so if you compare it kind of to a traditional management-based fee model, like an asset-based fee model at 1.25%, what most people are paying on their traditional investments, you'll end up being about 60 to 80% less in overall cost inside these life policies. Plus, you have the advantage of the locking in the gains, resetting of the index, the principal protection, and the death benefit protection as well.
Well, finally, let's stay with the topic of cost. When you hear criticisms about life insurance as an investment, cost is the main argument.
Yeah, I agree. I think if you go out and you do research on, investing in life insurance, it's not the same as an investment, but certainly costs are what comes up the most. And I think if you, again, do the comparisons and look at those articles, you'll see that rarely do they ever mention any of the topics we discussed today, such as the ability to lock in gains every 12 months automatically, take them off the table, the ability to have the floor to protect you from losses, resetting to capture market rebounds. None of them ever really go into the details of how these policies actually drive growth. And in the example I gave earlier of the client where we were putting in about $250,000, and they were able to take out over $2 million tax-free based on those historical yields over the course of their life. That's a net number after fees and costs have all came out. So if you compare everything and look at the total picture, it's really hard to match the yields you can get tax-free out of these policies. And the tax-free status, again, gives it a big advantage too.
Denver, how could people contact you who are watching and might have questions?
We have a great video series. You can go to wealthforlife.net and watch that whole video series. It shows you the ins and outs of life insurance, some different case studies on how our clients are using it. You'll see some more detailed analysis on the pros and cons, as well as some of the charts and graphs that go into some of the topics we discussed here today. So that's wealthforlife.net, or you can go to our office, 480-970-5663 is the phone number. Just give us a call and you're welcome to ask any questions.
All right, Denver, thank you.
Thank you, Scott.
My guest has been Denver Noes with Wealth for Life in Scottsdale, Arizona. I'm Scott Drake, and you're watching Retirement News Today.